And thank you very much to Energy for organising the lunch, and indeed again for organising this conference. This session has two presentations, or two different themes really of presentations. One is the first presentation is going to be presented by Michael Connolly, which is looking at the work of the Task Force on Global Production that's been coordinated by UNECE. And the second tranche of papers is really looking at some of the issues that we touched on in the earlier discussion when we're talking about the importance of firm level data to develop some of the stories that we think it's important for global value chains. I'll just say a few words about Michael. I did ask all of the presenters to provide me with something about themselves, and he provided that, which is a couple of words, so I'll have to make things up as I go along and embellish them. But Michael's an old friend, somebody we worked with for a number of years now very closely, and a good colleague, and he's currently the head of the National Accounts Integration and Large Cases Division in Ireland. It's a shame that we don't have an opportunity to have a discussion about the Large Cases Division work that you've been doing as well, because that's very interesting. And certainly I think that something that many countries have now adopted within their information system, and it's proving to reap benefits in many different countries. But you're also here today, I think, in your capacity as the project leader, if you want, or the chair of the UNECE Task Force on Global Production, which is the follow-up to work that took place in 2011, which was looking at globalization in the national accounts. And so Michael's going to give us, I think, a presentation of about 40 minutes he's been asked to. So we have a long time to discuss the rich variety of topics that have been discussed within the Task Force's work program. And at the end of the session, what I propose is that I'll have a series of questions that I'll open to the panel, and see how they respond, and then we'll open it to the floor before moving to the last three presentations, which are discussing, as I said, this issue of capitalizing on microdata.
Okay, thanks, Nadim. And thank you to UNECE for hosting this very interesting conference. I don't really need to go on about what I do. I think Nadim has given me a good introduction. There are quite a few members of our task force here, including Francisco from UNECE. This is the plan really for my talk. I'll give you a bit of an overview of global value chains. I'll talk a bit about the criteria for identifying economic activity and also ownership. And we talk about types of global production arrangements and some issues, and then we finish with a summary. Just this UNECE task force that I chair just gives you a bit of a background to it. It's established under the Conference of European Statisticians, which is a very broad group which goes way beyond Europe. It includes all of the statisticians from North America and Australia, New Zealand, and so on. So we also coordinate with the Intersecretariat Working Group on National Accounts, the Advisory Expert Group, the OECD National Accounts Working Party, and so on. We've quite a few members from the countries, and Eurostat, IMF, OECD, UNECE, UNSD, and the World Trade Organization are also on this task force. So it's quite a large group, and that's a sort of a mixed blessing, really. The background to the task force is just that following the globalization guide, which has been mentioned by Steve Landefeld earlier and others, I think, there were some unresolved issues in relation to global production, and our work plan was to provide to deal with some unresolved conceptual issues, and then also some guidance on the implementation aspects of the new standards, being the SNA 2008 and BPM 6. So global value chains, they represent the enactment of globalization. I suppose they're just evidence of it. It's at its heart, globalization is about flows of materials, goods, information, knowledge, finance, and people. And global value chains are the basis of such flows. And the design, configuration, and coordination of these chains to achieve maximum business potential are central to the role of the M&Es. And really the point is just, this is all about M&Es. And then just to elaborate a little, they make it possible to bring together all the raw materials, components that combine to make a product or service, and to deliver it through distribution systems to support users on a 24-hour basis if required, recover, integrate the residue into the waste system. So there's also that environmental side of it, the recycling and so on of waste back from the system. These chains span the world, and I suppose the example there, a global value chain may involve American designers, Indian software writers, Asian manufacturers, European system integrators, and support provision. So this is just to give a feel of the stretch of it, or the reach of these global value chains. This is just a graph to show, I suppose, what we mean by global value chains. And I think we had this question earlier on in the earlier session about, well, what's in and what's out. And if you look at the bottom of it, you see a global production chain, which includes the raw material networks, component networks, the final products. That's the production chain. And then when we expand it to create a global supply or value chain, we're talking about the additional marketing network, retail outlets, consumers, logistics, all this stuff. And we can see also there disposal and recycling also that has a role in this. So this would be a simple supply chain. This is just to try and simplify what exactly we mean. So it starts with the R&D design. We then have the raw materials required to create the product, the intermediate inputs, semi-finished goods, and the final goods assembly, followed by then by the, I suppose, the value chain side of it, or the value side of it, the warehousing, the retail delivery, and the customer service. And we have a host of services associated then with this: financial services, quality control services, marketing, and logistics services. It's just a little example. I know we've had loads of them, but here's another one. It's really just trying to illustrate, I suppose, the reach of a global supply chain. And what we see there is number one, we start off in Minnesota in the States. This company, Best Buy, they decide they need so many DVD players. So they contact Toshiba, number two, over in Japan, to produce these DVDs for them. But Toshiba don't produce DVDs. Instead, they ring up or contact what we call their factories for hire. And they're what we would normally call contract manufacturers, or suppliers, or we've a variety of terms we use. So they're immediately getting into the outsourcing of that. And then the Chinese factories for hire need the raw materials, the semiconductors or chips, to produce the computers. So they contact Zoran, number four, back over in California. Zoran then tells its own subcontractors to start creating these chips for it. And it contracts, amongst others, the Taiwan Semiconductor Manufacturing Corporation, very well-known contract manufacturer in Taiwan. They then get going, making some chips. They realize they need some equipment to produce these chips. They contact Applied Materials, that's number six, back over in California, and then they in turn contact D&H Manufacturing, another American company, to produce the machine tools or the equipment, some of the raw materials for those tools required to produce the chips, etc., etc. And we have a whole host of relationships here already. We have principals, we have factoryless goods producers, we have retailers, we've all different elements of the supply chain there. Okay, we'll just move on then. So why create a typology? Perhaps it's obvious, but anyway. It's a framework to classify the activities of the units participating in the global value chain. And it also allows us to give guidance then on the recording of their transactions according to the current international guidelines. You have to remember, I'm coming at this, and my task force is statisticians, and they're either members of the international organizations or our National Statistical Institute. They're from that. So we're trying to grapple with the problem, the data problem, rather than the policy issue, I suppose, or I suppose the perspective of the speakers earlier on was sometimes to say, well, we know what the policy issues are, but where's the data? So we're coming at it from a different standpoint, really. But the typology allows us to test test it on real case studies. In other words, that example we just saw, how can we fit that into a typology? And then elaborate the boundary between the different types of global production arrangements. That's important. Central to all of this is economic ownership. Who owns what? And the material inputs, the outputs, the intellectual property. We have to know who owns what, and that way we can then start attributing transactions to companies and ultimately to countries as well. And that's how the trade and value added initiatives work properly if ownership is properly attributed in the data. So we're also concerned with classifying the economic ownership. So in the case of factorless goods manufacturers, which we'll come back to again, if a principal owns material inputs, that principal is then classified as a manufacturer, even if it outsources the production process. If it owns the inputs in a production process, but outsources the process, it's still a manufacturer. On the other hand, if it doesn't own the material inputs, it's classified as a merchant or a trader, somebody who's just trading margins, involved in basically retail wholesale. We'll come back to this in a while, but this is pretty important. Just elaborating a bit on the typology of global production arrangements. We have arrangements in goods, arrangements in services, and then arrangements that are not related to the primary inputs, more to do with the direct investment structures and that. So in relation to goods, we have transforming materials owned by others, also called goods for processing. We have merchanting, and then we have factorless manufacturing. For services, generally IP and other branding and other services associated with that, subcontracting as well. And then the arrangements are to do with the other company members of direct investment structures that are not directly engaged in producing something, but providing other support services or even head offices and so on. So, to developing the typology, well, the typology, basically there's one ready-made, and Gary Gareffi there, and some of his colleagues, Tim Sturgeon and Mr. Humphrey, have developed these structures, and it's about the complexity of information and knowledge required to undertake the production process. The degree to which this complexity can then be mitigated, that's very important. Can it be programmed or automated in some way to remove the complexity out of it through codification, however that is. And then we have the extent to which suppliers have the capabilities to meet the buyer's requirements. And in that context, we talk about governance types. And what we have are different types of structures around the global chains. So one would be a very market-oriented arrangement. I suppose the automotive business might be considered to be market-oriented. We have a lot of suppliers just supplying finished parts to the manufacturer, may supply them to a number of customers and so on. And this is helpful in understanding how much coordination takes place. I suppose just about the idea of market-oriented arrangements, to really understand it, you have to say, well, what is not market-oriented? And what is not market-oriented is M&E, which is hierarchical, captive, so they do most of it within the boundary of the multinational itself. So even the contract manufacturers will be an affiliate in some way of the multinational group. And then if they do engage a third party, that will be on a captive basis where they must probably only work for them or almost work exclusively for them. So they basically control the access to the IP, the intellectual property, and so on. So the typology, the objective, like I said earlier, is to establish a framework to analyse complex global production arrangements and fit these arrangements into the current interpretations of the guidelines, the SNA, BPM, and the other ones. Now, the analytical framework I'm going to use is, there are two entities, one domestic, generally a principal, and then the second one a supplier, generally foreign. Now, there's a third one, which is a customer, and they're there all the time. And then describe the production arrangements from a domestic perspective. So when I look at these, we're looking at it from, I suppose, the country of the domestic principle, we'll see. And then break down the economic activities by country of entity. Now, what we want to do is identify economic ownership of inputs and outputs, assign economic activities in line with ISIC or whatever, NACIF or European, distinguish the type of output, and determine a treatment for the international transactions. So, this is the first of a few of these diagrams. 3 we'll go through. And the first one really is just an illustration of processing. So this is where I'm a principal in USA, and I engage a processor in Mexico to produce a good for me. Now, you can see there in the arrows, the black arrow, I'm supplying the material inputs required for this production process to the Mexican company. And I'm also paying them a fee. This is so I'm importing a service from Mexico. This is what's called in the new manual, in the balance of payments 6th manual, manufacturing services on physical inputs owned by others, formerly called goods for processing. So the supplier then produces the good, and in many cases now, in the current regime, will send that on to the customer. And what we have is that we have a transaction between the principal in the USA and the customer, wherever the customer happens to be. Then we have merchanting. And merchanting is slightly different. We have a principal again, who, instead of engaging somebody to manufacture something for them, they just simply buy something from them. So they're purchasing a finished product from a supplier, and then they're selling that good to a customer. And in this case, we said it's Canada. Okay, so we've the principal in one country buying from another country and selling to another country again. Then we have the third case, and this is factoryless manufacturing. Again, we have a domestic principal, and we have a supplier. In this case, I've just used USA and China as the examples. And then ultimately, we have obviously a third customer, a third party who is a customer again. In this case, the difference, probably the critical difference, is that the material inputs for the supplier are coming from another source, and they're also being acquired by the supplier. And this is the basis for recording this as a factoryless manufacturing transaction, rather than saying it's simply a goods for processing transaction. In a goods for processing transaction, the inputs are supplied by the principal, and the processor is supplying a service. In this case, the supplier in China is considered to be producing a good for the principal. This is quite a difference. And we've made a lot of this difference. And then this then goes into the problem of how we classify the factoryless manufacturer, because they don't supply the inputs. But I just wanted to digress just for a second, put up a slide of Foxconn. You can see just how big they are. Foxconn are one of the biggest contract manufacturers in the world. And you can see where they are in China, in the Czech Republic, in Turkey, various sites in the States, in Brazil. And we see also how much they've grown from 2001, I think it is, to where they are now. You can see their share price, their returns, and so on. So this is big stuff. I think that's the point. This is a big activity. This is impacting on everybody. This is not something that you're hearing about going on elsewhere, and you can say, well, it's not happening where I am. So I just wanted to just put that up in passing. And the situation is also complicated as well by IP and IP ownership. And I really just wanted to just put up a slide here, which is a very simple slide showing the flow of IP within a multinational group. This is a genuine example, but there's a US parent. It has a Dutch company. This is a subsidiary. It also has a Cayman Islands Irish registered non-resident owner of the IP, and it has an Irish resident trading company, which is owned by the Cayman company. So what happened first is that the US parent sold the IP or the intellectual property to the Cayman company. I don't know whether the statisticians in the Cayman Islands picked this up. It's a moot point, I suppose. But then the way then that you have then an Irish trading company producing a product. Just say it's pharmaceuticals, for example. And so the royalties come from the Cayman to the Dutch company, which then can sell the IP on to Ireland because it is licensed to trade in sub-licenses. It's like a conduit for this IP. And then the money, sorry, just to stick with the diagram, the money goes in the opposite direction. The money goes from Ireland to Netherlands, back to Cayman, and obviously back to the parent. And the issue there is that the double taxation agreements within Europe and between Ireland and the Netherlands allow no withholding tax to be taken from these royalties. And then the Dutch company, because of the promotion of intellectual property owned arrangements in the Netherlands, can then pass on the money without withholding too much tax. But the point really there is just that along with the trading arrangements that I just spoke of, the IP is also very complex. It's intangible, difficult to track down, and again, for statisticians, a challenge to uncover these structures and then to deal with them properly. Okay, so just talking about the factoryless goods producers, they are the principal. The factoryless goods producer then engages a contract manufacturer who sources the goods themselves, the inputs, produces a product using the IP of the principal and passes it on to the customer. If we think about the product has sort of three inputs really. It has the intellectual property, it has the material inputs. Now the intellectual property clearly coming from the factoryless goods producer. The material inputs, well, in the story I'm telling, they come from the factoryless goods manufacturer. But you can see that it could be just tactical on the part of these companies, whether they buy the inputs or whether the principal buys the inputs. It's dependent on the size. Like say Foxconn was your contract manufacturer, Foxconn can probably buy inputs at a much finer price than any principal, or many of them anyway. And then we have just the manufacturing services that are supplied by the contract manufacturer to produce the product. Just elaborating a little about it, this factoryless goods producer retains the technical know-how and the product design. So firm control over the intellectual property. It also controls the outcome of the production process. In many cases, they have engineers on site in the factories, and they have access and delivery of the final inputs to the customers. The contract manufacturer simply supplies pre-specified goods at predetermined prices. We went with this matter, I suppose, to the AEG, which is the advisory expert group. It's one of the highest level national accounts groups in the UN. And they agreed with the task force that these factoryless producers supplying intellectual property and marketing services and controlling production processes while using contract manufacturers to produce goods are to be considered goods producers and should not be classified into distributive services. Like if you think about it, if these factoryless goods producers are classified to wholesale, there'll be huge profitability accruing in that sector, and that would give very bizarre productivity results. That's one of the consequences of that. But anyway, the task force went again a few weeks back to the AEG again to elaborate a little, to talk about economic ownership of intellectual property and also the factoryless goods producers. The recommendations we had on economic ownership of intellectual property really entailed the graph we looked at earlier, recognizing the Cayman Island company as the owner, the economic owner of the intellectual property. Now, you could question that was more like legal ownership and the de facto economic owner is the parent, but the practicalities of statistical collection and data collection really require that we identify it as as the economic owner, and also that this SPE in the Cayman Islands is a statistical unit and is recognised as one. It's a foreign SPE within a group, so it's non-resident to the parent. That's another basis for and then it prepares accounts, which they all do, and so on, which are considered to be a basis for determining autonomy on the part of the company. So that was all accepted. But then when we came to the factoryless goods producers, that was a different ball game. And Steve Landefeld's discussion earlier about the Federal Register, this document here, that sort of changed things quite dramatically. Like the country that had made the running on factoryless goods producers being categorized as manufacturers or classified in ISIC as manufacturers, after some reflection, decided that they were no longer in favour of this proposal. And I think they had some support as well elsewhere at the AEG. And I suppose as things stand now, we have to test our experiences and test our conclusions. But the thing is that I suppose when we talk about these factoryless goods producers or people engaged in processing or people engaged in merchanting, they're all, in many cases, or in some cases at least, they are the same multinational enterprise doing all of these things. So to classify them as just as manufacturers because they're doing FGP type transactions once, doesn't necessarily stand up on reflection. And I think we see that too in the task force, that really there has to be some way of classifying them that accommodates the different types of business model they might follow for different product lines, because that's what happens. They might be factoryless for one product. We saw there at the start, that one of the slides I put up, that Toshiba were factoryless for the DVDs. They didn't make them, so they got a contract manufacturer or a factory for hire to do it for them. So they're factoryless for that. But we know that Toshiba do make a lot of products, so they're also manufacturers in their own right, and they may well be engaged in merchanting. And I think in reality there's a very complex arrangements within these multinationals, and I think we have to come back at this classification issue again, and on the basis of more case studies. I think everyone talks about the Apple example, but Apple may not be a factoryless goods manufacturer even. And there were certain transactions we saw that would suggest that maybe that Apple owned the inputs, and in that case they are more like a processor or engaging in a goods for processing transaction. But without getting lost in all of this, that's more or less things as they stand right now. That we've come to a bit of a speed bump, and we have to reassess and reappraise. And I think what Steve was talking about earlier is timely, really, that we have to look again and see how everything will fit together in some sort of a bigger scheme of things. But and really, what I would be interested to hear from you was really what your view would be about the challenges around this classification issue, but also when we are talking about these factoryless goods producers, merchanting, and goods for processing, they have one thing in common. In all cases, the exports cannot be captured in the country where the FGP is resident, or where the principal or whatever, the merchant, is resident. In all of these cases, the goods are being made in another country, and then they are being sold or shipped to a final customer from there. So they never cross the boundary, the national boundary. So they'll never appear in the trade data. So then that poses a major problem for statistical compilers, and firstly because people using their data are forecasting, probably looking at their monthly trade data and say, well, what will the national accounts say? Or else they're forming views anyway on the composition of trade and so on. But as this divergence increases, in other words, as more global production takes place, that amount of exports that are not explained in the domestic data, but explained by imputing or adding in extra transactions for exports from contract manufacturers or merchants or whatever. This is a serious problem for trade statisticians as well as national accountants. We had big debates at home about this, and my colleagues getting very concerned about the value of trade data decreasing, and he's worried about this and so on. So that's a challenge, and how do we deal with that? And the obvious way is we survey for it, but Steve was speaking about the burden, the cost burden on the producers of the data for us. So, and then this production abroad, how to measure it itself, that's another challenge for us. That's sort of all I wanted to say. The manual, or the guide that we are producing, the guide to measurement of global production, covers a lot of other issues, multi-territory organizations, all sorts of different companies, and covers a lot of practical problems and a lot of conceptual problems. But I think we've hit on the core ones here: economic ownership, the status of certain traders, how we should classify them, and then just the sort of more basic problem of trying to identify data for inclusion, such as these exports that are no longer being captured in the classic system that we had, or that used to work. Okay, that's all I got to say. Thank you.
Thank you very much, Michael. That was a very thorough presentation, and indeed on time, so that was very good. I'll just perhaps begin by making a few observations. This issue in terms of the classification of firms has been a very thorny one for a while, and I should hold my hands up and say that I'm a member of this task force, and so I too have been making these same recommendations along the way. But it'd be useful to give some background to what we proposed to the AEG in terms of classification of firms. I think it's clear, and most people would agree, that the classification of these factorless producers to the distribution sector is clearly not reflecting some form of economic reality. I mean, if you think about the basic definition of a distribution firm within ISIC and also within the framework of the national accounts, they're engaged in something that isn't transformative. But we observe that these firms, they're creating value through the generation of intellectual property, be it brand or design or R&D. And so there's a recognition, certainly within the task force, that there was something transformative about the creation of intellectual property. And this distinction between goods and services, which we've always known has become very blurred, has become more blurred, I think, over the last few years. And so the sort of the philosophical view that we took was that when it came to identifying firms, in terms of the classification of firms, we shouldn't make this increasingly false distinction from a national accounts framework or national accounts perspective between the goods inputs and the services inputs. So from there, we realized that we couldn't keep the status quo. We couldn't recommend preserving the status quo, that these firms are distributors. So we had to find an alternative. And there were fundamentally two different alternatives. One was that they would become a producer of, if you want, intellectual property, so they become a service firm. Or the other was that they became a subsector of the manufacturing sector itself. And we chose the latter because we wanted to preserve the link between what the firm was engaging in and why it was doing it. It wasn't in the business of producing R&D or IP for the sake of it. It was producing the R&D to be embodied into a good. And more often than not, of course, the IP itself reflects perhaps a significant share of the overall value of the product. So we took the view that it made more sense to be within the manufacturing sector. But that's all to say that it's in the context of where we are today. We were restricted in terms of what recommendations we could make on the basis of not moving too far from the current ISIC standards. And I think the question that I have to the panel is whether or not, if we could start again, this would be the industrial classification system that we would necessarily start with. I mean, Michael presented, for example, a typology of different categories of firms, and would that be something looking forward that could form the basis of a new type of classification system for firms that better reflects the production reality? I'm certainly of the view that the ISIC, or the classification system that we have today, is perhaps no longer reflecting what we want it to reflect, and we may need to think anew about how we move forward, perhaps not in the next few years, but certainly for the next revision of ISIC. Can it reflect a different type of reality? So that's the first question that I have to the panel. The second question, and this presupposes that, and I hope that many of you have read the draft handbook on global production, which is a long, lengthy publication. But within there is this flow diagram of how we treat flows of IPP and how we attribute economic ownership to different firms. It's a very complicated flow diagram. And if you have had a chance to have a look at it, I'd appreciate some feedback from you in terms of how useful you think that is. And indeed, that's also something that I throw open to the panel to see if they can provide some insights onto it. I think the issue more generally is perhaps a philosophical one. We started off with the perspective that we should really try and stick as close as possible to the underlying concepts of the national accounts, i.e. risks and rewards of economic ownership. And if you could establish, for example, risks and rewards of the IPP to a particular firm, then that's where the assets should appear on the balance sheets. But we realized that moving in that direction was hard to measure, but also moving away from a different type of economic reality, because the reality, of course, is that taxes are often paid on a different notion of ownership. The legal ownership is where the taxes are paid by firms on their profits. And so we'd be introducing an inconsistency, if you want, between the raw data and the national accounts view of the world. But it will be interesting to hear whether or not others have had a chance to think about economic ownership more generally for IPPs and how, in an ideal world, these could be recorded. I think certainly from my own view, the idea that we allocate intellectual property back in this example to the Cayman Islands is one that I've always been uncomfortable with, but it does reflect a fundamental reality in terms of the way that flows are appearing in the system. I think for me, what needs to happen at an absolute minimum, of course, is that where we do accept that view of the world, so fundamentally a legal perspective in terms of ownership, we also have to make sure that the balance sheets accurately reflect the investment on firms. Otherwise, we end up with distorted productivity figures, and that's a major issue. So again, your general views on IPPs would be very useful. And finally, just a question to Michael, because this was something that I raised in my presentation as well, and it'd be useful to have some feedback, because I think it's central to some of the discussions that we will be having, and we have had over the next few days, was basically Ireland's perspective on global production more generally, because Ireland is one of those countries where we see a much bigger focus on GNI compared to GDP, and it'd be useful to have some insights into that. So those are the questions that I'll open to the panel first, and then perhaps we can take it from the floor. Please, do you want to go first?
Yes. Hello. Well, first of all, I would like to thank you, the presenter. I think it has been a quite interesting presentation. So I would like particularly to comment on your first issue, I mean the use of new classifications, or the potential use of new classifications. We all realize that the use of ISIC, or NACE as we call it in the European context, has certain limitations in terms of analytical value. And I would like to comment particularly on the experience that we have in the use of the business functions that has been developed in recent years. We have been running a couple of surveys on international sourcing, and in order to get proper responses from the participating countries, we decided to use this business function classification. And the experience with the respondents was good. I mean, they understood well this concept. They found this closer to their real activities, and it was easier for them to respond to the questionnaires. So this is probably one of the ways that we can explore in the future. Actually, we have plans in order to make these business functions, to give more, let's say, more importance in the European context, by introducing this in a potential future regulation. So I think that this is one of the ways we should go, but still I think we will have to deal with NACE, with ISIC, because it's linked to CPA, it's linked to the harmonized system, so we cannot get rid of it, that's clear, but we may need to study other potential avenues. Thank you.
Okay, thank you. Michael, do you want to?
I think what Lewis said has been said before previously. I've heard it elsewhere of the use of the business functions as a good complement to the basic activity classification and institutional sector type classification as well. I think all of these, and I thought what Nadeem, what you mentioned earlier about foreign and domestic, or international producing foreign owned and international producing domestic owned and so on, that came from the floor, I think. I think this is a problem, but there's obviously not it's not an endless sort of menu we can have for, like, would we really seriously want to remove some of the classifications that are there now and replace them, or is it? I suppose, as somebody said earlier, it's not working as it is, so something has to be done. The IP decision tree, I don't think I have to, that's for others really to comment on. The economic ownership, in an ideal world, well, we were trying to get away from the ideal world and try to deal with the real world, and that's what brought us to recognizing the SPE in the Caymans as the de facto economic owner, and it fitted with the, like I said, the definitions of an institutional unit and having the autonomy. Now, obviously, the criteria for it, autonomy, is not that rigorous, because I think it is more akin to a legal owner. But I mean, it seemed to fit within the standards of the SNA 2008 that we could do this, and there was a certain pragmatic element to this decision. And I think, as always in statistics, you have to be practical. We could talk forever about conceptually the way it should be, but sometimes we have to make a tough decision. But Ireland's perspective on global production, well, we have been using GNI for years now in Ireland. It's just because of the way our GDP has been inflated through, I suppose, the activities of multinationals. And but global production in general is a huge challenge for us. All of the household names in the software and the pharmaceutical sector are active in Ireland, and they have major operations. For us, they can really distort our results, and we have to then look at some measure that clears them out of the numbers. And up till recently, GNI did that. But then Steve again mentioned the corporate inversions, and they're companies that are coming into Ireland, and because of the way we record income, what happens is that you have a new headquartered entity in Ireland, which is owned by all of the portfolio investors, all the small shareholders now, who now have shares in an Irish headquarters rather than wherever it was previously in the States. But the outward ownership of all the subsidiaries of this inverted entity are still foreign direct investment enterprises. And all of their earnings, which are taxed in the jurisdiction that they earn that money, come back to Ireland. So to the extent that the Irish entity does not make a dividend payment, they add to our GNI. And what's more, they add to Ireland's contribution to the EU budget because of that. So we get zero out of this. And it's probably our legislation somehow accommodates this occurrence, but it's something that's exercising the minds of some senior civil servants. I think for the past few years we've been highlighting this, but it's so. The point I'm trying to make is that globalization, it just comes at us in all different ways, and global value chains, and like that's way up at the top of the structure, the inversion, but talking earlier about the right down at the bottom as well, and it just has the potential to cause havoc in a small open economy like ours, and we really have to work hard, and that's what our large cases unit does. We collect all the data centrally, we look at all the data integrated, and we sort of ensure a coherence across the data, and in that way we ensure that it doesn't pollute our numbers, and it has a consistent impact on our, say for example, on our trade data, on our production data, on our profits data, and so on. And that's absolutely vital for us. But anyway, so they're my responses.
Thank you. Oscar?
Thank you. Well, I would like to start with the part of the economic ownership. Indeed, in an ideal world, we would take out all those investments out from the Cayman Islands and put them where they really belong, because there's where the action is. Now, of course, that's a problem. It's difficult. On the other hand, why do we make these statistics? It's for the policymakers, for the public at large, to inform them, to know what's going on in the world. And then it would be nice to have that ideal world, because all these different and difficult concepts of the Cayman Islands and stuff like that, they simply do not understand. There we have to take into account what message do we want to convey to the people that use our statistics. We do not make them for ourselves, we make them for the public at large. So I think some effort in that direction should be made, but again, what is possible and what is not. As far as the classifications are concerned, there's a big problem as well, because it's true, if you would start today, everything would be completely different. And I think, well, Steve already mentioned this morning, you can have a very nice roadmap, like the things you all want to achieve, but if it's very different from the people, from what the people are used to, if it takes a lot of new surveys that the enterprises do not like, because they have to make money and not fill out those surveys, it's not going to happen. It's simply not going to happen. So changing everything, no, that's completely out of the question. But maybe something else is possible. And there again, the example of the business functions that were mentioned, something extra without too much burden, that might be a solution that is possible to achieve in reality, especially because much information you can get from few enterprises. If I look at the business functions approach, I'm not interested in the little bakery around the corner where the people go to. It's irrelevant. I want to know what the big multinationals are doing.
Thank you all. So I guess we can now have an opportunity to open this up to the floor. I should just say that on business functions, tomorrow we have Ron, who's going to be pretending to be Peter Borg-Nielsen, who's going to be giving a presentation on business functions. So we'll learn an awful lot more about that tomorrow as well. Gary?
Yes, so I just wanted to comment on some of Michael's efforts on the typology. I think a lot of the categories you were mentioning stem from this distinction that was made back in 1994 when that commodity chains literature first came out between the producer-driven chains and the buyer-driven chains. And the new phenomenon that you're pointing to here, I think, was around different types of global buyers, and there were essentially 4 types of firms, and you were sort of alluding to them. One set were the global retailers, the JCPenney's, the Sears, the Walmarts, the Kmarts, especially their private good line. So, and what those retailers began to realize is if they orchestrated production in Asia or Latin America themselves and bypassed the branded companies, they actually could make a lot more profit. So that was an enormous boost, along with the rise of these companies that were called global marketers, the Nikes, the Reeboks, the Liz Claibornes, who basically had a product design and no factories, no stores, unlike the retailers. A third big group came on in the 1980s, which was the global supermarkets, the Tesco's and the others from the UK who were sourcing product directly from Africa and elsewhere, and the same thing happened in the US. And then finally, a fourth category were the so-called manufacturers without factories, different from the factory-less goods producers, because the manufacturers without factories were a whole set of, let's say, American apparel companies like Levi Strauss or VF Corporation that basically sold off all their factories because they realized they could make a lot more money as brands and designers, and production could be done offshore. So when you think about those 4 groups of global buyers, the retailers who with their private label merchandise, the global brands or global marketers, the supermarkets, and these manufacturers who outsourced all production, the one thing they all have in common is that they were setting up what they called global sourcing networks. And in those networks, you didn't have to have any kind of good exported to those producing countries in Asia or Latin America or elsewhere. Occasionally you did. Occasionally Nike would develop some kind of a particular product that it would want to have incorporated. But the key thing about those was that you basically had arm's length relations, or you had no ownership ties. That was really different from the maquiladora type production here in Mexico, where assembly goods manufacturers needed to import all the parts, and you had to deal with the manufacturer. So you had these two types of chains, the producer-driven chains, where the producers or the manufacturers had to supply the parts, but all of those other types that are now kind of being lumped together under factoryless goods producers, the key idea of a sourcing network was you had to have a coordination office, they usually called them an overseas buying office, that identified the factories, that regularly monitored them, did the quality control, et cetera, but no goods had to exchange hands. So when you say what category could we call them, I would think an Apple or a Nike, I could see clearly calling that a manufacturing service. But it would be a real problem to kind of call them manufacturers, because when you look at a Nike, Nike's got 950 suppliers around the world. The Nike suppliers have 1 million employees plus. Nike itself has 45,000 employees, almost all in the US. So the reaction that you were getting from the factoryless goods producer concept was from a lot of groups that were interested in the outsourcing of manufacturing from the US or Europe, what's going on in terms of employment, labor standards, et cetera. So the idea that Foxconn, having that kind of a global manufacturing empire that you showed, its production somehow being linked to Apple, which per se is getting a lot of IP, intellectual property on design, marketing. They're doing a lot of things in the chain, but what they're not doing is making anything tangible. Now, so one possibility is how far can you get with manufacturing services as a category where a lot of the value becomes service value, not so much production value per se. Xi mentioned earlier there was a group that was chaired by Ed Leamer for the National Academy of Sciences in 2005. And I was a member of that. One of the things we recommended from a statistical point of view is say it would be useful for the US to know the organizational identity of importers. Because if this buyer goods phenomenon was in fact, buyer-driven chains was important, and we asked who was actually importing the goods, who was the organization of record, that would tell us something. I only know of one study done by USITC in 1995 by Jackie Jones using microdata that tried to look at the organizational identity of US imports and found in her study that something like 50% of those imports were by retailers. Just the retailers. And there's problems because, of course, you can have multiple company names, but even sort of so that might be another possibility. Would it be useful to start to classify imports, at least by the kind of company, because that would feed into the notion that you've got buyer-driven chains that are essentially different from producer-driven. One final point, two, on your typology, one thing that we're seeing in a lot of the global chains literature is that in any given industry, it's got a combination of vertical integration, arm's length market trade, and different kinds of networks in the same industry. So we have to just be aware that internationally we're seeing a lot of those kinds of differences taking place. So I think going forward, it's really it's important to somehow distinguish that these sourcing networks are indeed important parts of how the global economy runs, and that who the lead firm is somehow significant. And I think that's your sort of classification issue. The identity of different types of lead firms, ownership could be important. They are multinational enterprises, but increasingly, China, Brazil, other countries are starting to have their own lead firms. So, but I think the issue is critical. I know there's a lot of kind of political pushback right now, but I think maybe the idea of manufacturing services, I mean, it's a category that makes the most sense to me in terms of face validity, because you're not then getting into the point of saying that that Foxconn's employment should somehow be linked to the US manufacturing sector. Let me stop.
Hubert, you wanted to say something, didn't you?
Thank you. Thank you very much. Well, it was just a comment from the trade specialist in the sense that up to now, and reacting a bit on the things that what was important was ownership. This story started with trade analysts, and we don't care. We don't care as long as we are not interested in trade balance and balance of payment. Now, I just want to say that because up to now, only national accountants has taken the floor, or even when they are disguised as trade specialists. The story started when economists realized that countries don't compete on goods, but on tasks, and that comparative advantages in countries today are on task. Some countries are better at designing, others at manufacturing, etc. And trade in goods, or merchandise as we say, is just the glue. First, it embodies those different tasks or value added, and it's the glue which glue together, the various part of this value chain. So for us, it's very important to track the physical movement of goods irrespective of ownership. Otherwise, we won't understand the distribution of competitive advantage, which makes our task much easier than the national accountants, because as long as custom authorities will collect tariff duties and do their statistical business, we will have information. Now, I just wanted to say that ownership is not everything, and task is important, and it's easier to measure. I was sure you will react.
No, let others do. Of course. Sally.
To follow up on that point about ownership isn't everything, and this whole question of goods for processing, FGPs, and the classification issues, we were meeting with our political types about the FGP issue in the United States a couple months ago, and trying to explain to them what the issues were regarding FGPs versus goods for processing, which they hadn't heard of. Whose fault is that? Maybe ours, I don't know. But the policymakers are quite far behind in understanding all of these concepts. And this ownership issue is not how most of them think about trade. If they do through the income route, the income being returned, and hence the inversion issue is so salient because of that. And so we have a big challenge in thinking about how best to do this classification in the future, because ultimately we'll need several different types of ways of slicing and dicing the trade data, which we already have. We have the merchandise trade statistics, and then the balance of payment statistics if we ever get them in the format that BPM 6 asks us to provide them. And we'll have various different sets of statistics, and we're going to have a lot of confused policymakers because of that. So on the one hand, I think that's a challenge for us, but on the other hand, I think it's interesting that we don't talk to the policymakers much in these venues in terms of trying to elicit what are they most interested in? I'm sure it's going to come down to jobs and tasks and things like that. That's my thought, anyway. But we have a long way to go just to, once we, in this dynamic of educating the policymakers and also eliciting from them what their needs are. It's a two-way street.
Eva, you wanted to say something? Thank you, Hubert.
There you go. I just want to bring this back to I think 2005, 2006, when actually Rob Dippelsman and I started discussing good for processing, and then Anne came in, Anne Harrison, the editor of the 2008 SNA, and we knew that we were on something big, and we developed it. And I think the way you have set it out, Mike, is how we perceived it that it should be done. The fact is that we brought in the element in terms of the ownership of the material was something that came from the classification group that actually we brought along because we had to have that discussion, and that was just simply a mistake. because when we were discussing this, it was basically not about what we call economic ownership, but really about the notion that is very central at the system of national accounts and balance of payment. It's economic control. Now, we try to do that in ownership, that you really own something, and it was more about being able to control a process. And around that issue was also that very big notion about how you get all these double counting in the exports and on the import side. And we really wanted to get back to that notion of better understanding these value-added issues. Now, that is still that we should get at the heart of our considerations. And from that general sort of philosophy, we should try to find these solutions rather than going too much. What some of the SNA or the so-called national accountants are doing is really trying to, twist it within the national accounts legal text. I think that's not very helpful. I think we should look back to, that notion of eco control, what we really want to say. Now, Jerry, that whole discussion about services, so you produce manufacturing services and we're getting there. Now, whether that is a manufacturer or this is, somewhere else, in our opinion, this was a manufacturer because that is what he wanted to control in that process. He was really in control of that production of a good. That was basically where we saw it was a manufacturer. And I think that's also where the classification experts were. That is the underlying notion in the ISIC Ref 4. But we should get it right this time in time to how to define that notion of economic control.
One last question. And Hubert, you can give eBay the money now. To Jaco.
Thank you. Just a fairly general comment about the point about what is politically feasible and what is desirable in terms of how far should these reforms go. I think the basic fact that one has to start from is that at the end of the day, we want statistics to be as close enough of an accurate reflection of what is happening in reality as possible. I think the second starting point must be that globalization is obviously a process that will continue. So today, some of these arrangements might still be not really fitting very well into what the world used to look. If you then think back to Steve's point about you need to do this incrementally and you can't push too far ahead, I think there is then the question, okay, what elements of that can you solve within the context of the post-2015 agenda or the ongoing revisions, and which of those points do you have to acknowledge, well, that's probably how these things would look like in an ideal world, but we need to move. We need to move there eventually, because otherwise the danger is that you start, you remain stuck really with the concepts that you have now, and incrementally tinker at the edges, but you don't really move systematically in the right direction. So I think, on the one hand, conceptually figuring out where the right direction is and where you eventually want to end up, even if that is decades down the line, is a very important task, so that you then can inform the process of, okay, what can you do at what stage of the revisions, and how do you step by step move into that direction. But I think it doesn't make sense to then say, okay, we don't really have a category between services and manufacturing, so these companies, we're going to try and ignore them at least for the next 5 to 10 years, and then we'll somebody else is going to deal with them.
Okay.
I just wanted to make a comment or two. Firstly, thanks, Gary, for those comments. I think we'll take them on board and fit them into our problems. I just don't agree with well, I can understand the Hubert's perspective on trade, but as a national accountant, we're just trying to see where the value add is accruing, and to do that, we must actually find where transactions are taking place. In other words, who now owns something or who has sold something. That's the only way we can really earn money or provide services. And just in relation to that comment, Ivo, your comment too about control or ownership, I would have said that's correct in the FDI relationship, but when it comes to the trading of goods and services, it really is the ownership, isn't it? It's the buying and selling, really. The control, I think, is about the FDI and but that would be the way it seems to be anyway. Yeah, and just the other thing, just finally about that factory as goods producer issue. Like, we had an agreement a year ago from the AEG, this advisory expert group. It was right then. 12 months later, it's wrong. So what I was trying to say, I suppose, in my presentation was it didn't just suddenly become wrong, but I suppose, after this having happened, it provided an opportunity for a bit of reflection, and on reflection, there are issues there that we need to address. I think that's the point. Okay, thanks.
Thank you. It's been a very interesting session. I think that you can see just from the rich discussion that we've had how complicated the work of the task force in global production has been, and indeed will continue to be for a while, because there are a number of challenges along the way. I will just make one closing, and take the privilege of being the chair to make one closing comment for this particular session in the context of the changes that were made, introduced into the SNA, and Hubert will know that I have to rise to the bait. But one thing that's often forgotten in the discussion when we have this talk about goods of processing and the rules that we implemented in the SNA is that what we actually did was brought in to line the view from a trade perspective with what was happening already within the national accounts in terms of domestic transactions. What's often forgotten is that if there were two domestic firms, the ownership principle always applied. There was never any imputation for a change in ownership. And so certainly for large economies this mattered. I mean, for the US, for example, a lot of transactions, or most transactions, would have been internal, and there would have been no change in ownership, and there would have been no change, no imputation. So we already had this view of the world that presented a distortion between firms. Those firms, for example, that were trading would end up having a different production function from those that were solely within the domestic territory. So what we did was bring the two into line. Now, of course, that's caused difficulties along the way, and it's caused problems in terms of measurement. And it wasn't as if this was gone into completely blind, but it does reflect the view that within the accounting framework today, we're trying to measure, if you want, a financial transaction view of the world, in line with risks and rewards of ownership, as opposed to a production function view of the world. And fundamentally, the world that we're trying to measure is a globalized world, and that reflects to some extent that type of reality. So, I mean, those are the closing words of this particular session. As the chair, Hubert's not allowed to come back and say anything in addition to that. I have spoken to Luis and Oscar, and I think that what we'll do at this stage is break for 10 minutes and then come back and then take the last 3 presentations, and we should finish at 5 still. So thank you. And a round of applause against Michael for putting up with all this. For 10 minutes.
So I'm off, am I?